Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Each calendar quarter, we publish an update on the financial market outlook and our investment strategy for the year ahead. We've recently concluded this process for Q2 2022. Our latest quarterly investment view document is titled Watchful, Not Worried. The title summarizes our take on the global economy. While we're watchful of an asynchronous mid-cycle slowdown of the global economy, we're not worried about a recession yet. Our regular listeners should be familiar with our proprietary recession probability indicator RPI, which we use as our preferred composite measure of assessing the probability of a recession occurring in the next 12 months. Looking at the RPI, recession probabilities have risen recently, but from the lowest level in their 42-year history. Even after the recent rise, the RPI is still close to some of the lowest points of the previous cycles. Recession probabilities tend to rise during the mid-cycle slowdown of an economic cycle, which we did expect the global economy to experience this year. Near-term financial market performances are likely to be driven by concerns about slower global growth and rising risks of a recession. We made this central to our investment strategy, and we defined two scenarios. The base case scenario with higher probability sees a mid-cycle slowdown, and the worst case scenario with lower probability sees a recession. Accordingly, while we've not positioned for a recessionary environment, we thought it is prudent to position for a global growth slowdown. At the same time, we are watchful of rising recessionary risks. Considering this, we adjusted our portfolios. At the asset allocation level, we increased our exposure to US Treasuries further by deploying some cash, which remains at an overweight. Our incremental allocation to US Treasuries is through broad allocation across duration segments. Broadly, we remain neutral equities and alternatives and underweight fixed income. On equities, where we remain neutral, we put the themes of earnings growth and slowing macro at the core of our investment strategy. Accordingly, we made a couple of changes to our sector recommendations, making our sector portfolio defensive at the margin. We upgraded global healthcare to an overweight from neutral. We downgraded financials to a small underweight from neutral and moved information technology to a neutral from an overweight. Worth noting that our downgrade on IT is centered on our more cautious view on technology, hardware, and semiconductor segments, where we expect the supply-demand dynamic to turn unfavorable to equity prices looking ahead. Our country, style, and factor preferences remain unchanged. Our other high-conviction ideas include clean energy themes for the medium to long term, aerospace and defense, food security, energy security, and cybersecurity as plays on rising geopolitical tensions and deglobalization, consumer services, airlines, and hotels, restaurants, and leisure as plays on reopening. Turning to fixed income, the fixed income assets which we've been underweight had a difficult start to 2022, with global central banks tightening monetary policy to combat multi-decade high inflation levels. Yields on US Treasury bonds have risen sharply in response to this hawkish rhetoric. We now see limited upside to the US Treasury bond yields. Moreover, US Treasury bonds, alongside other developed market sovereigns, should outperform during periods of weak global growth. Therefore, as indicated earlier, we added to our overweight on US Treasuries through a broad allocation across duration segments. We closed our preference for India short-dated bonds, but our other allocations remain unchanged. We remain neutral alternatives, which offer a range of opportunities to diversify and hedge against slowing growth. Gold, which we kept at an overweight, provides a good hedge against the global growth slowdown over the next couple of quarters. Our analysis also suggests that macro and market defensive strategies within the hedge fund space are likely to do well too in a broad risk-off environment. In the FX space, we expect the differences in the central bank policy action to continue to drive currency markets over the remainder of the year. US dollar has benefited from its haven status and the hawkish Fed, but persistent twin deficits and moderating growth outlook in the US could cause some weakness in the greenback over the medium term. We expect the British pound sterling to weaken against the US dollar and stay flat against the euro. Elsewhere, we remain negative on the euro given relatively less hawkish ECB and weaker eurozone growth, and Japanese yen due to dovish Bank of Japan. In summary, while we are watchful of downside risk to global economic growth, we're not worried about a recession at this stage. In line with this thinking, we cut risk exposure marginally in equities and increased our allocation to US Treasury bonds. We also think alternatives could offer diversification and downside protection benefits. Thanks for listening. We hope you found this podcast useful. If you did, please do share it with a friend or a colleague. For more information on what was discussed on this podcast and to receive a copy of our latest quarterly investment view document, please reach out to your ADCB relationship manager. You can also log on to our website at www.adcbam.com for more information. This is Kishore Muktinutalapati signing off.